Last week, the S&P 500 ended its 6-week consecutive win streak. We see red right across the board, and with earnings season continuing into the week, we expect volatility to continue with the presidential election taking place just weeks away. We also notice right across the board the S&P 500 does look very richly valued. We have companies that are in fact trading above 30, above 40 on a PE perspective. Now, today's episode, we are looking at 5 of the best growth stocks to buy before 2025, and each one of these have some massive upside. We're going to look at the intrinsic value. We're going to give you what margin of safety we believe each one of these 5 stocks have, 10, 20, 30, 40%. And we're also going to discuss the upside that Wall Street themselves believe you will gain with this company just by holding it over a year. Now, the first one is Adobe, where we get a triple buy right across the board. We see it's trading towards the lower end of the 52-week range with a forward PE sitting around 26.5. And over the last year, it is down around 7%. Over the last 10 years, though, this stock has massively outperformed the S&P, up 590%. In terms of moving forwards, well, pretty much every single quarter over the next year, they're anticipating strong growth. In fact, double-digit earnings per share in comparison to the year-on-year perspective. And they've also outperformed analyst targets over the last 4 quarters, 100% track record, therefore giving us faith they'll hit their November EPS for 2025 target, lowering the forward PE to 23.54. Now, each company, we are going to look at some of their metrics. First one with Adobe, we notice this is pretty much times 7 over the last 10 years and is expected to continue over the next 12 months to $20. Remember, free cash flow, we want consistent increases over the long term. That is what we get with Adobe. We then see their sales growth pretty much every year, double-digit increases to their top line. Last few years has slowed down, nonetheless, 10% in 2023, 11% on a trailing 12-month basis. And from a numerical standpoint, we can see that this company has in fact 5-folded their top line, $4 billion in 2014, 19.4 in 2023. We also notice they've returned excess cash to shareholder pockets, maybe not a massive amount, but they've bought back around 10% of those shares outstanding from 2014. Remember, this in essence gives you a larger portion of control of the company. ROIC, our favorite metric, remember 10% or more, give us faith management are able to effectively allocate their capital. It's been increasing since 2014, looking very strong in the 30s over the last few years, even higher on a trailing 12-month basis at 36%. So looking phenomenal, especially for new investors and also those who are looking to add to their position. We also get very good operating efficiency, going from 10% in 2014 to 34% in 2023, and the margins absolutely phenomenal, more than the minimum 5% we want to see, and very high numbers, 36% in the latest year. We then get to the net debt to EBITDA, referring to the earnings before interest, tax, depreciation, amortization. 0 over the last 4 years, 0 over the next 12 months. This tells us the number of years it would take Adobe to pay off all of their debt net of cash on hand. Wouldn't even take them 1 day, signaling they have a very, very strong balance sheet, and that is a major plus when we do take a look and analyze companies in general. Now, in terms of our intrinsic value, we got to $580 in today's episode. We're going to explain how, essentially using the DCF model. And as we can see here, we have the free cash flow year on year. We have the average growth rate at 23%. Now, we've gone for 12%, which is the median rate we have today. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 580, signaling 20% upside. Now remember, these numbers are very subjective. You can grab a copy of this model by clicking on the pinned comment below, getting your own numbers, whether it's for Adobe or any others. Full transparency though, for those at 10% who want to see $504, indicating 4% upside, and for those that want to see it 14%, 667, leading to 38%. So we take the 12% into the final slide, where we always like to do an MOS. At 10%, we execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, we'll buy at $522 in today's episode. Then we keep going till it's near the current trading price. Now, not at the 20% level just yet, around 15 to 20%, so at least in fact 15 MOS up to $493, although we do notice Wall Street a lot more bullish. They see upside of 30% over the next year, giving their price target of $627. As always, give us your thoughts in the comments below. 15 to 20% MOS with upside of 30%, looking very good in terms of their financial metrics. A lot of them are increasing, a lot of efficiency noted right across the board, and the balance sheet does look great. As always, give us your thoughts as we go along today. We then move on to Elf Beauty with a strong buy from Wall Street, a buy from Seeking Alpha, a hold from Quant. This one trades in the lower end of the 52-week range, again very similar to what we saw with Adobe. In terms of the forward P, well, sitting at 31.5, and over the last year, pretty much flat. Over the last 5 years, up 557%, massive outperformance of the S&P during the same time. When we look at the next 4 quarters, now Q2, they do expect a drop to the year-on-year EPS. However, the subsequent 3, they are expecting some very large growth, especially in Q4. And by quite some distance over the last 4 quarters, they have outperformed what the market had anticipated. Now, over the next full year, March 2026, big growth anticipated, which will lower the forward P down to 25.3. In terms of the free cash flow per share, we do notice it has dropped from 23 to 24 to 114, but over the next 12 months, they are expecting this to pretty much double. And we get the sales growth very strong, 77% in the more recent year, 48% in 2023, and on a trailing 12-month basis at 68%, showing us that this company's top-line growth is just starting to move in that right direction. In terms of total sales, $0.2 billion in 2015, again 5-fold into 2024, $1.02 billion, trailing 12 months showing us that we expect another very strong year over the 2025 period. Now, in terms of shares outstanding, we do notice they have gone into the habit of diluting your position as a shareholder, but so far, based on the share price return, you probably wouldn't care too much given how strong it has been and the massive outperformance of the overall S&P. ROIC, not consistently above the 10%, but it has been increasing from the lows of 2021 at 3%, 16% in 24, 14% on a trailing 12-month basis. On the operating margin, we do get a little bit of inconsistency, but again, very similar to the ROIC, has been increasing from the lows of 2021 at 15% in 2024, which is really the lowest that we want to see. Something possibly to keep an eye on, especially as their top-line revenue does increase at a very rapid rate. Free cash flow margin, again, above the minimum 5% in the more recent period, but still looking very inconsistent. Net debt to EBITDA, finally, what we do notice here, 0.75 in 2024, and in fact decreasing from the highs of 4 in 2015, 0.6 expected over the next 12 months. Again, very similar to Adobe, it does have a very strong balance sheet. Now, in terms of the intrinsic value, $160, and just to show you, in terms of the DCF model, we have baked in quite a large rate in terms of growth. This is a company that has been growing at a very good rate. In terms of the growth rate, we have 30% here, and as in fact we just saw, they expect over the next full year the free cash flow to double, so we have been a bit conservative, as we can see in our 2025 estimations. Depending on which rate you use, you can see the upside here, but we just wanted to show you for clarity, using that 30% does give us the intrinsic value of $160, which is below Wall Street. They see $170. They believe it will grow at a faster rate. They see 56% upside over the next 12 months. And when we do use an MOS, well, we can see in today's episode for Elf Beauty, you are getting at least 30% up to $112. So 30% MOS, 56% upside. Is Elf Beauty one that you are considering or maybe have recently purchased? Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about undervalued stocks that we do believe deserve your attention, as well as running through what's gone on in the market over the last few days. You will also be able to gain access to October stocks that we believe have massive undervaluation. We talk a lot about each one, the upside that Wall Street see, and flag those that sit within our own portfolio. So do click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access to 22 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P. Moving on, we have Octa. Now this one, as we can see, another double buy rating, although a hold from Quant. This one trades again at the lower end of the 52-week range. Forward P just under 28. Over the last 12 months, well, up 7%. Over the last 5 years, however, this is down around 33%. We do like to see this growth anticipated over the next 4 quarters, and again 100% in terms of historical forecasting accuracy. We do note growth expected in Jan 2026, lowering the forward P to 24.84. Now, free cash flow per share, it has been negative, but we do like to see this. It has in fact increased into the positive in 2020. Growth has been very inconsistent, but a nice jump into 2024 and expected to continue that upwards trajectory over the next 12 months. Growth, whilst it has been slowing, still very strong, 22% in the more recent year. And when we do zoom out, we can see absolutely phenomenal. They reported 40 million on their top line in 2015, 2.26 billion in 2024. Shares outstanding, we do know they have diluted your position as a shareholder, something they do continually do on a year-on-year basis, something just a flag. And the ROIC right now isn't looking too great. We do notice it negative pretty much consistently over the last 10 years. They aren't as of yet profit making, as we can tell by the operating margin. However, what we would say is it is getting smaller and smaller, which is very positive, 9% in the trailing 12 month. So we do expect this very soon to flip. And this is where the money is to be made when you're investing in companies that are turning that tide. Free cash flow margin looking very good over the more recent years, picking up from the poor performance it had in 2015 to 2019. 22%, 25% on the trailing 12 month, definitely what we like to see. Remember, the minimum target there is 5%. And net debt to EBITDA, phenomenal. Like all the companies we've reviewed so far, wouldn't even take them one day to pay off all of their debt net of cash on hand. Now, Wall Street see 40% upside with a $101 price target, pretty much where we see it in terms of our intrinsic value, and we've gone for 10% moving forwards. As we can see, this indicates 40% upside. For those that want it more conservative at 8, 24% upside, and those at 12%, 57%. So given the 10% rate, we do notice a nice MOS in today's episode, 20% at around $80, up 30%, not quite there yet, but sitting somewhere between 25 to 30% for Octa with 40% upside over the next year. We then move on to Crocs, where we get a double buy rating and a hold from Quant. This one trades in the midpoint of the 52-week range, a forward P of 10.4, and we can see over the last year, massive performance, up 53%. Over the last 10 years, what an increase, up over 1,000%. And when we look over the next 4 quarters, they're expecting this more recent one to be a drop and then for it to pick up. And as we can see, management have smashed their targets over the last 4 quarters, with nice growth expected into December 2025, lowering the forward P to 9.55. Then we get to their free cash flow, which has looked very strong over the last 10 years in terms of growth. Nice increase expected over the next 12 months. Their actual top line growth also looking very good over the more recent period, 11% in 2023. And we actually see more than triple from 2014's 1.2 to the 4 billion reported in the more recent period. Shares outstanding, they also do some share buybacks very inconsistently, but over the period they have bought back a substantial number of shares in relation to the total in 2014. ROIC as well looking very good, 70% in 21, 24, 30% in the more recent year. Margins, we get that operating efficiency increasing from the 3% in 2014 to 26% in 2023. And over the more recent years, we notice the free cash flow margin is looking strong and has been increasing. Lots of efficiency noted with this company. We then get to the net debt to EBITDA, where we see it lower from the 5.5 highs in 2015, 1.43 in 23, expected to come down to 1.29 over the next 12 months. So whilst not as strong as Adobe and Elf Beauty and Octa in terms of the balance sheet, still nonetheless looking very healthy. We then see that Wall Street have a price target of $175. They see 31% upside, and our 223 will show you how effectively we have gone for some very low rates moving forwards. So $223, 66% upside is if they can continue to increase their free cash flows at 2%, which does seem reasonable. And when we use the margin of safety, well, in today's episode for this company, we are seeing quite a large amount. In fact, at 40% is where this company is right now. Wall Street, whilst they have a price target, it is lower than our intrinsic value. Nonetheless, 31% upside over the next year. We then move on to Celsius holding the energy drink with a double buy and a strong sell from Quant. This one is trading at its 52-week low with a forward P sitting just below 40, down 43% over the last 12 months, but up 19,688% over the last 10 years, although we do note it has come down quite some way from the $100 all-time high that we saw in 2024. Now, in terms of their growth, we do notice it's very mixed over the next 4 quarters, and over the previous 4, we have a 75% track record. They did miss, although by 1 cent in quarter 4 of 2023, and with growth expected into December 2025, forward P anticipated to be around 30.54. Now, we notice free cash flow has turned positive over the last 2 years, with double expected over the next 12 months. Sales growth absolutely phenomenal. Last 3 years, we're seeing it in the triple-digit rate, which is why when we do zoom out, their top line has gone from 10 million in 2014 to 1.32 billion in 2023. We also notice they have been diluting your position, but if you're a shareholder and been holding since 2014, as we said, share price has increased dramatically. This wouldn't bother you at all. In terms of ROIC, 24% in 23, 27 on a trailing 12-month basis, and the margins, as we can see, 20% in 2023, but they have struggled over the last 10 years, only recently become profit-making, and free cash flow margin, very similar in terms of the reflections there, 8% in 23, 15% on a trailing 12-month basis, but pretty much keeping up the trend of companies today. Phenomenal balance sheet, not even 1 day to pay off all of their debt, net of cash on hand. Now, our intrinsic value at $52 is on the assumption they can continue to increase their free cash flows at 25%. We see just in the more recent year around 24%. So that gives a $52 price target, 69% upside, and Wall Street a little bit lower, still $48. They see 55% upside over the next year. And in terms of that MOS level, 10% a buy at $47, 20% a buy at $42, 30% around $36, and in today's episode for Celsius, you are getting a 40% margin of safety with, as we said, Wall Street very bullish, 55% upside. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. You can also grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Celsius or any others. And don't forget to click on the pinned comment where you can also sign up to the free weekly newsletter and join us in the Patreon where we talk about our own buys and sells. As always, have a great day and we'll see you all on the next one.